I was saying, this is going to be our last review session together. I thank you all for joining. And yeah, that was pretty cool to be here. In the evaluation forms, please do let me know how I can improve on my lecturing or whatever I'm doing here. So just write in a comment that your lecture wasn't that good. Don't write that. Yeah, so today we'll be just focusing on the extra homework, because I think that the homework that is given is pretty verbal. You can just go ahead and take a look in the book, see what's going on. It's all straightforward, just a lot of concepts, terms throwing around, and that's homework. But this I think is very important. So what we're going to do is we're going to do extra 3, extra 4, and then extra 5. Or maybe extra 3, 5, and 4. Probably that. So before we start, are there any questions on extra homework? Not on the normal homework, it's all in the textbook. Did any of you solve the extra homework? Okay, you should. You definitely should solve the extra homework before tomorrow's quiz. Okay, has all of you been in the lecture yesterday? Everyone know what's going on with the fish meters example and WACC? Okay, that's pretty good. I see some nodding faces. I like that. So that's pretty good. That's also a very, very important example. You should definitely review that and solve this homework before tomorrow's quiz. If you do that, and if you do that knowingly, I think you'll all get a very good grade. So, let's start with the WACC. What does WACC mean? WACC is weighted average cost of capital. So when we say weighted average, we're going to weight the averages, and we're going to have some components. So let's break it up. Okay. So weighted average cost of capital will be equal to the summation of, we have how many components? 5, right? This is a very bad sick. Okay, so we have 5 components. Every one of them will have their weight. And every one of them will have their tax. Well, some of them won't, but we'll just assume it's 1, so it won't have any effect. And every one of them will have their K. This K, we're going to use it as the rate, or it has different meanings on each of the components, so there's no clear thing that I can tell right now. So we have 5 components. I'm going to look up here. One is long-term loan, right? For long-term loan and bonds, these are the tax rate applies to these. So when we see long-term loan and bonds, we're going to do the tax rate. But on the others, preferred stock, common stock, and retained earning, there won't be any tax. So you can say TI will be 1 for them. And for these, TI will be equal to 1 minus the tax rate. Right? The others, preferred stock, common stock, retained earning. TI will be equal to 1. Or you can just ignore that. This is very important because we only applied the tax to these 2. That's good to know. So, I'm going to skip the weights and I'm going to do the KIs for each. Okay, so KI for long-term loan and bonds are pretty easy because it's going to be always given, almost always, if it's not a very hard question. Well, let's say it's an easy question, like this. So the KI will be just nominal interest rate given in this details section. So what is the KI for bonds? Yes, it's 12%, and for long-term loan, it's 8%. So let's write that down. KI will be equal to nominal but don't mix them up. They have different nominal interest rates. They're not equal for both. We wrote. So let's write that down. Not the same. Same. Cool. Okay. The KI for preferred stock will be, again, in the details. There are 3 numbers there that we can use. The rest of them is a story. So the 2 numbers we're going to use is, we're going to not use the 20,000 shares. We're going to use $3 per share and then $15 per preferred stock. Yes, dividend of $3 and then price is $15. So you buy a stock for $15 and you get $3 of dividends at the end of the year. So there's a ratio right here, which is 3 divided by 15, right? So there's not a lot of logic behind it like we did in previous examples, so I'm just gonna roll with that. Just stop me if it doesn't make any sense, okay? Okay. So this will be dividend divided by cost per share. Okay, I'm going to cheat up here and then look up the KI for. Okay, so KI for common stock and retained earning are again going to be in the details, and I think you've done this in class and in the homework as well, where we were using the beta and the risk-free return, market return, and all that. That was a cool small equation right there. So let's write that down, and you should put that down on your equation sheet. As I did. So it will be risk-free plus the beta market return minus the risk-free return, right? And this is going to be the same. Now, we know the TIs, we know the KIs, all we need is the WIs, right? WI will be equal to, will be equal to the amount of the ith component divided by the summation of amounts. Each will be the same. It's just basic weighted average, right? And then there's some more extra steps to it. So let's do it. Let's do it. Okay, for long-term loan, we're gonna do tax rate of 0.35 right here. So we're gonna apply the tax rate here. So for long-term loan, it will be, before we go on, we gotta just find the summation. 100,000 plus 200,000, 800,000 plus 500,000, 400,000. Okay, so it's 2,000, 2 million. Right? Let's do it like this. Okay, so the summation is 2,000. The amount of long-term loan is 100,000. 100 divided by 2,000. And the tax rate will be 1 minus 0.35. The KI will be the nominal interest rate, which is given to us as 8%. That's done. That's 1. And we got 1. Bonds. We have the amount as 200,000. We have the summation as 2,000. Tax rate will be the same. And the KI will be 12%, which is again given to us. Okay, preferred stock. The amount is 800,000. summation is still the same. We have no taxes applied to this, so we're just going to put 1 there. Don't mix it up with 0 because it's going to affect all your calculations just because I said there's no tax. Put in 1. And then KI will be equal to dividends per share divided by price per share, which is 3 divided by 15, 0.2. Yeah. Right, just to make sure. Yes. First stock, common stock. Common stock has an amount of 500 divided by 2,000. Again, tax will remain the same. Now we gotta calculate this cool dude here. Let's do it here. RF plus beta market risk-free will be equal to, in the details, let's look it up. In the details, we can see everything that we need. Risk-free is 5%. I'm going to write it down while telling you. Risk-free is 5%. The beta is given as 2. And the market return is 13%, right? So we're just going to put that in. 0.05 plus 2 times 13 minus 5, 0.08, which will be equal to, let's do that, 0.16 plus, is that plus? Yeah, yes, 0.21. Right, so we're going to use this KI for both common stock and retained earnings. Let's put that down. 0.21. Retained earnings has an amount of 400,000, again divided by the summation, no tax, the same. So we're going to have let's call this smiley face. Smiley faces everywhere, and then we're going to add up all the smiley face results. The smiley face will be equal to WI times TI times KI. Okay, let's do this. 100,000 divided by 2,000 times 0.65 times 0.08 will be equal to 0.0026, and then 200 divided by 2,000 times 0.65 times 0.12 will be equal to 0.0078. 800,000 divided by 2,000 times 0.2 will be equal to 0.08, and then 0.25 times 0.21 will be equal to 0.0525. And we have 400 divided by 2,000 times 0.21, 0.042. Let's sum that up, plus 0.0026 plus 0.0076 plus 0.08 plus 0.0525. Yes, 0.1849. Okay, this is the result that we got from summing up all the smiley faces, right? So what does this mean? Why did we go through all this for the last 10 minutes? So this is our weighted average cost of capital. When do you all remember what MAR was? I think every one of you saw MAR in this course before. So this, when we compare this and the MARR, we should have a higher MARR because of a risk, what is called a risk premium. We're going to put a line between this actual thing and our expected MARR. That line is called the risk premium. Let's say it's 1%. So our MARR will be equal to this plus the risk premium, which is 1%, 19%, right? So we're going to compare every project depending on that. So this actually provides us the basis of MARR. And the risk premium will come from other parts of the company, which will, I don't know, somewhere. Everyone got it? How we can compare this to MARR? Any questions? Yes?
For your WI, those are like 100,000 and then 2,000. Like, you add multiply by 1,000.
Yeah. Multiply by thousands, but because it's just a ratio, it doesn't actually really matter. Any other questions? I assume everyone's knows how to do this and can do it if it's on the quiz. Cool. Okay, then let's go to question 5 of the extra. Okay, we're given this super long case study, which has a lot of information on the company. This is all we get, and we're asked to do first step of determining whether each element is an asset, liability, income, expense, equity, or other. That's not classified in this. So let's start with that. Okay, so we're going to determine if it's asset, liability, income, expense, equity, or other. And let's do it like this. Let's all try to think about it, rather than me just giving out the answer. But it's also in Canvas, so if you want to look it up, sure. So salaries paid, what do you think this is? An income or an expense? It's an expense. Why? Because we pay, it's obvious. Utilities paid, pretty obvious, I believe. Sales, income. Insurance paid, expense. Paid, expense. Cost, expense. Paid, expense. Just says it here. Okay, so this first part is usually, if the person that you're speaking to is a nice person, they're going to give expenses and incomes on this part, and then the other stuff on the second part, right? So you can usually go with this. But if it's not if your accountant wants you to figure it out, you're just going to get a pile of these, and then you got to figure it out on yourself, right? But this figuring out either it's expense or income is pretty easy, I assume. The rest will, yeah, let's go. Okay, gross equipment. So does everyone know the difference between assets and liabilities? I'm going to assume yes, everyone knows. No, I'm going to assume the opposite and tell you. So an asset is something that we own, that we can rely on. Like this chair, this desk for the university. They know this is theirs, they can use it, they can either sell it, use it, wear it, do whatever they want. It's theirs, right? They paid for it, so they got it. The liability is how they paid it. They are liable towards their employers, like me and Erhan and Francie, because they have to pay them. It's their liability. If the university gets a loan from people, that's a liability. They have to do something about that, right? It's their task or duty. We can think like that, right? So that's the difference between asset and liability in a very informal way. So, gross equipment. Do you think that's an asset or a liability? Asset. Accumulated depreciation. Liability. Yes. Because as the depreciation happens, then you have something on your shoulders that you gotta pay for later on, right? Accounts receivable, the money that we can receive from other people. Let's say one of you owes me money. Is that a burden on me, or do I like that? Yes. So it's an asset. Accounts payable, just the reverse. I owe you money, so that's a liability for me. Loan, that's around the same thing. Inventory, the amount of stock I have in wherever. So that's something that I can use later on, which is asset. Cash and checking accounts, the money I have in my wallet and in my bank, which I can use, I can rely on, so it's an asset. Okay, this is the part where it gets kind of uncool. I don't like that. So let's start with retained earnings, right? There's something in finance called equity. I'm sorry that I can't explain that in English for you all, but an equity, you should all look it up, is something pretty cool. And a retained earning is an equity. Yeah. Just know it. Just know it. Yes.
Can you repeat that? What is it each?
Equity. Mm-hmm. And common stock is also an equity. Dividend paid is the alone guy in all this place, and it's other. Just does not belong anywhere. Right. So at least by common sense, we can get like 90%, 85% of the items listed here, right? We can see if that's an expense or an asset or a flow. So if it's a flow, it can be expense or an income. If it's not a flow, it's an asset or a liability. If it's something weird, it's other or equity, right? Okay. So the second question asks, make the income statement, the balance sheet, funds flow, yeah. So to do this, you just got to memorize how those statements are made. We did the income statement in quiz 5 and in the previous review session. Let's just do it again. So you all remember the first part of the ATCF thing that you all did in quiz 5? We had revenue, that was a plus, and then we have revenue, that was a plus, and then we have costs that all were minus, right? This time we have a lot of costs. Look, salaries are costs, utilities are costs, insurance are costs, land is cost, depreciation, we had it, we have the interest paid for loan. So we have the revenue, or this time it's called the sales here, doesn't matter. So revenue will be equal to sales is $85,000, right? We're building up all the income statement right now. So costs, we have salaries paid, which is 25,000. Let's write it down, salary. And then we have utility, which is 2,000. Let's not spend a lot of time and say all of the expenses. Right? All of the expenses right here. Minus, minus, plus, minus, 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 minus. Right? Which ends with rent, which is $10,000. Right? So, this is part 1 of our income statement. So we all know where revenue and all other the costs belong in the statements. They're not in the balance, they're not in the cash flow, they're in the income statement. So now we do the thing that we want and get net income. Net income will be equal to, as you all remember, $85,000 minus all this costs. And I did the math before, I hope you trust me. And this will be equal to $14,000. Right? What was next after net income? No, income. We have taxes, with the tax rate given as 40%. So tax rate 40%, we just multiply 14,000 times 40 to get 5,600, right? Then we have net income, which is 14,000 minus the taxes we paid on our income. 14,000 minus 5,600, 8,400, right?
The income is the taxable income, correct?
Yes, before tax income. Let me write that, before tax. Cool. Now, as a company, we have our income statement. So our net income after everything, taxes, costs, we have $8,400 left in our pocket. This is gonna go where? What are we gonna do with that money? So we have dividends to pay because some people buy our stocks for a reason. And now we have to pay their money, right? So this is one. Net income will go to first dividends. We are legally required to pay dividends if we said we're gonna pay dividends, right? So let's look it up how much we paid. Right here, $1,000. And then the second one is, we're just gonna save up the money and use it later, right? Just put it in the bank, write it as a cash asset, which will be called retained earnings, right? Yes, so this will be equal to 7,400. So net income will go to two places, either dividends, if there is, or retained earnings. Where else? Right? So this is our income statement. This is page 2.
Why does retained earnings not match the retained earnings on the sheet?
That's what I was thinking too. Because probably we get some money from the common stocks at the end, and the retained earnings is higher because of other income that wasn't listed. But yeah, thank you for pointing out that. But this doesn't change the answer right here. They may not match in the statement, but net income goes dividends and retained earnings only. So if we have more retained earnings, maybe because we got some more from the previous year, we got some unlisted incomes going on. So yeah, that's an accounting trick, I guess. Right, so we did income statement. Let's go and do the balance sheet. This one's my favorite because it has my favorite equation in this whole class, which is assets equals liabilities plus equity. This is a feedback on your results. If your assets does not equal to liabilities plus equity, you did something wrong. There's something wrong going on. And if they're equal, you're probably right, but you might still be wrong. But don't worry about it. Always check ALE. Always check that. So, assets. how do we write the assets? There's a super important rule when writing all your assets, liabilities, and equities. It's called the liquidity, right? We list everything from most liquid to the least liquid. Why do we do that? I don't know, but it's a must. If you're keeping account of all the assets, liabilities, you have to give them in order of liquidity. So what's the most liquid thing that you can think in terms of assets? Cash. We got cash. Let's see. Yes, right here. 2,500. And then next, the money that people owe us. We can always go and say, hey, give me back my money. I need the money. Accounts receivable, right? Accounts receivable is given as 1,000. And then we have two other things. One is inventories, that the stocks, the stuff that we have in the warehouse, we can just go out and sell it in a week or so. So inventories, and it's given as 500. And then we have the net equipment, which will be the gross equipment minus the depreciation, right? Because we have the gross equipment, the thing, and then the wear and tear down that we show in the income statement. We're just gonna subtract that and get the net equipment. So our gross equipment is given as $40,000, and our depreciation, which we're going to use the accumulated depreciation, not yearly depreciation, right? Because it's going to accumulate and get the book value to zero eventually, right? We're going to use the accumulated one, 15,000. So this will be 25,000. So our total assets will be equal to 25, 26, 29. Right? Liabilities. Everything okay with the assets? Everyone clear? It's pretty straightforward. Just memorizing everything. We're just looking it up on your formula sheet. Liabilities. So again, from the most liquid to the least one. So the money that we owe to people, account payable, right? And then the money that we owe to the banks, which require more legal action and all that stuff going on. Loans. Let's see. The loans is given as 10,000, and the accounts payable is given as 2,000. That's it. Total liabilities. So it'll be equal to 12,000. Right? So now that we did these two, we know that our equity must be equal to 17,000. Right? So, in equity we have common stock, the money that we got from the common stock, we owe to the common stock, and retained earning. Okay. So, we know that equity must be equal to 17,000, right? But I don't think 100 plus 7,000 is going to be 17,000. So what are we going to do? We're going to use what's given to us, or if it's not given to us, we're going to correct the error in the equity as the required accounting trick. It's usually listed as errors in the real cool accounting books. I don't think any of you is interested in that, but yeah. So we're going to do hidden error, and we're going to add until we get to 17,000. this will be 16. Right? Now the equation is satisfied. The gods of accounting is cool with us. And we did our statement. What was this called? Balance sheet. Balance sheet statement. Whew, funds flow. Okay, so funds flow. We got two funds flowing, sources or uses. So we're gonna determine this on like in a logical sense. Let's do sources first. So we definitely have as a source of fund the net income. We already figured that out, which was 8,400, right? And then we have the depreciation. You may say, hey, depreciation makes our stuff old. How is that a source of income? You're right. It makes our stuff old, but that's an implicit cost. We say that it makes our stuff old, but we don't take the money out of the desk, right? So we just show it as a cost so that we can save on the taxes. That's how finance works. So that creates a source of income for us. Yes. But we're not going to use the accumulated depreciation. We're going to use the depreciation of this year that's given to us. And then we have the... Okay. Before writing the last thing, let's use the uses. Right? These are all fixed. Loan repay. We have a loan repayment of 5,000 listed here. And then what's fixed? Dividends paid. We paid the money, so its dividends paid is going to be 1,000, right? And these all should be equal again. Oops, my bad. Should be 1,000. So now we have the increases and the decreases. They could be different. So let's go one by one, right? Inventory. If inventory is increased, what do you think it's going to go to? Source or use? But we increased what we have in our warehouse. Is it a source of income for us? We use the money. Right now we use the money to get more stuff. Right? So it's going to be use of funds if it's increasing. So if it's increasing, use. If it's decreasing, this is how we're going to write it. If it's upwards, it's going to be increasing. If it's downwards, it's going to be decreasing. Source. Everyone got it? Why it's use or source? We're paying to get more inventory, so inventory is increasing, so that's a use. Now there's the place to check. Inventory. Last year it was like this. This year it was like this. So it decreased by 5,000. If it's a decrease, what is it going to go to? The sources. Because we sold 5,000 units of inventory, we get money for that. So it's going to belong in here. So decrease in inventory by 5,000.
I think that was wrong. Yeah.
Oh, yeah, that was loan. My bad. Oops. Okay, right here. Still, same applies. 5,000, 500, 800. 300 difference. We sold. We get a decrease in the inventory, which is a source of funds. So this will be 300. Thank you for correcting. Now, the next one. Equipment. If it's an increase in equipment, do we use money or do we source? Do we get money when we increase the equipment? Yes, we use the money because we got this, we got this, we got this. So we use the money. So equipment increases use, and equipment decreases source. Let's check. Okay. So gross equipment, 40,000, 32,600. That means we increase the equipment, so we use the money, right? Right. So it's going to go to increase in equipment by 8,000, 7,400, 7,400. 40, just to be sure, 40,000 minus 32,600, 7,400. Cool. Okay. Next thing we have, I'm gonna put this here, then here. Then the next thing we have is increase in accounts receivable. If it's an increase or decrease. So accounts receivable increasing means that we have more people that owe us. We have more people that owe us. What do you think it's going to be? Yes, it's use, because now that I've given you money, you owe me more. So it increases the accounts receivable, but I've given you money for that. So it's a use. Let's see what happened to accounts receivable. It increased, right? So it's going to be a use. Increase in accounts receivable by 300. I got two more things left. Bear with me. Accounts payable and then cash and checking account. Okay, accounts payable. If it increases, is it source or use? It's a source. Yes, because how does it go? So we increase the accounts payable. Yes. Yeah, so decreasing in accounts payable means we decrease our loans, so we source. We use the funds. We decrease the loan that we have, we owe to other people, right? Just want to make everything clear. Everything should make sense. Accounts payable. Oops. Let's see. Accounts payable has decreased. So decreasing means it goes to use. Decrease in account payable, which will be about 3,000. And then the cash will be, if it's an increasing cash, is that a use or a source? I don't know. Let's check. Yeah. This one is the hardest one to, this one is the hardest one to figure out. I still have some problems with it. It's not very intuitive, but it's how it goes. Cash is, if it increases, it's a use of funds. If it's a decrease, it's a source of funds. I can't explain why. It doesn't make sense to me, but it's how it is, right? So we got the cash here. I'm sorry. But yeah, this is how it goes, and I can't do anything to change that. If it makes sense to you, that's pretty cool, but yeah. So 500 to 2,000, that's gonna be cash of 2,000. Now let's see if they're equal if we did everything right. Because we looked at gross equipment, we did accumulated depreciation right here. We did accounts receivable, this. You see all of these has two parts. So we need to compare if it's increasing or decreasing. So now let's see if they're equal. 8,400 plus 10,000 plus 300 is equal to 18,700, and then this will be equal to 2,000 plus 5,000 plus 1,000 plus 7,400 plus 300 plus 3,000. Oops. Yes. So they're equal. So we did everything right. And as a quick tip, as someone who still struggles with the cache and the use or source, I usually do all of these before and then leave the cache at the end and check where it belongs, right? Because they're gonna have to be equal. So I believe everyone now can do all the sheets. Everyone knows where everything belongs. Like if someone was to say, hey, is accounts receivable in which statement? We're gonna say balance sheet, right? But if they say increase in accounts receivable, we're gonna say funds flow. Right? Any questions on this? I'm not gonna go into the financial ratios. I don't think Erhan taught financial ratios yet. Did he? Yeah, it's gonna be probably after quiz. It's gonna be on the finals, so before finals, I suggest you to check the ratios. And we got 10 more minutes, so we can do question the other. Page 3. Okay, yield to maturity. So this is a very, 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 very easy thing. It's like quiz 1 or 2 stuff going on. The only trick that you need to know is what is the rate? What is the coupon rate, right? So it says that we have a 10-year bond. We pay $1,200 for it. It has a face value of $1,000. Coupon rate is 8% paid quarterly. We need to take all these things seriously. The bond expires in exactly 6 years from today. So someone in the world bought a bond that has an age of 10 years, and you bought it from them in 4th year. So you have 6 more years left on that, right? And you pay $1,200, and it has a face value of $1,000. Let's see. So we have 6 years left on that, right? And it pays how many times a year? Quarterly. 6 years left. Paid quarterly. So we have 24 payments left. 24 payments left. We're gonna see why it's very, very easy to solve. Just by showing the beam diagram, the cash flow diagram, whatever you want to call it. So we bought it at $1,200. It's a downward for $1,200. It's 0. Why 0? Because that's the time we bought it. We don't care about the past. We just care about our money. It doesn't matter. Right. And then the face value is $1,000. So this means that we bought it for $1,200. We're gonna get some coupon payments on every payment, and then at the end we're gonna get the face value. We're gonna say, hey, this is the paper that I got from you. Give me back my $1,000. So at the end, we're gonna receive $1,000. Right? Now we need to find the payment that we're gonna get every quarter, because it's paid quarterly. So we have an APR of 8% quarterly. Right? So we need to do all that compounding stuff that everyone hates, I guess. But because this is not compounding quarterly or in a different time, we're gonna go with the easy way and say 0.08 divided by 4, which is pretty legit. If you do that formula, it's going to give you this. So it's 0.02. So this is our coupon rate. We just found our coupon rate. Right? So we're going to get paid on this rate. And it will be equal to coupon rate, let's do it like this, times the face value. Just to make sure, yes, will be equal to payments. So we have 1, 2, 24, 23. So we're going to get the same payments every time, which will be equal to 0.02 times 1,000 will be equal to $20. Right? Let me check. Yep, perfect. So these all will be 20, 20, 20. And then at the end, we're gonna still get our $20 back because still there's a payment on that $20. So this is the structure of this thing, this bond, this coupon that we bought from some other dude. Right? So there's one more thing that we need to find out. Yield to maturity. Yield to maturity is basically the IRR for this thing, right? So we're gonna find the present value with an interest rate that says 0. That makes this 0. And this, we're gonna do it for this beam diagram. So we have a minus here. Let's do it. Minus this plus 20 times the P of A with an interest rate and with 24 payments plus 1,000 P of F I 24. And when you find this, just put this over there. So these, let's do it like this, okay, equals, so the interest rate that gives you this is your yield to maturity. I'm not going to do it, we've done it before. You can do it anywhere else in Excel, whatever. Yeah. Just know how to get the yield to maturity. That's pretty easy. Just make the equation. That satisfies EVI equals 0 is yield to maturity. Is everyone clear with how we find the YTM? Can you all see it in the board? Yes. Are there any questions? Okay, before the quiz tomorrow, solve this again. Solve the fish meters example. Look for question 1 and 2. They're pretty verbal stuff, but just see what they mean, what beta means, and all that stuff. And this is a very conceptual quiz, so if you have time, go over homework 6 too online. But I believe the extra homework is pretty important. So I hope you get a good quiz tomorrow. And thanks.